You nail the technical analysis. Your entry is perfect. Your trend lines are spotless. But by the end of the week, your account is still bleeding capital from a dozen tiny, unexplained losses. Strategy is only one variable. Even a winning system will collapse if it's deployed in a mathematical environment it wasn't designed to handle. This balance scale shows how every Forex pair is a simple ratio. When you look at the euro to US dollar, the euro is your base currency, and the dollar is your quote. You are simply measuring how much of the quote currency it takes to buy 1 unit of the base. But beneath that straightforward ratio is a marketplace, and participating in that marketplace costs money. These hidden structural fees, specifically the spread, which is the gap between the buy and sell price, and slippage, the delay in getting filled, quietly drain your account. Look at this profit bar. If you're scalping for a quick 10-pip gain, and your pair has a 3-pip spread, you've sacrificed 30% of your profit before the trade even executes. If you don't map your specific trading style to a currency pair's hidden cost profile, the physical mechanics of the market will actively sabotage your profits. For day traders and scalpers, survival dictates precision. Because they move in and out of the market multiple times a day aiming for small gains, they require an environment with virtually zero transaction friction. This leads directly to the major pairs. These are the most traded assets in the world, and they universally feature the US dollar paired against another massive global economy, like the euro or the Japanese yen. Because the US dollar serves as the primary global reserve, billions of dollars change hands in these specific pairs every single hour. This creates a hyper-liquid market, meaning there is always an immediate buyer or seller available at your exact target price. That massive daily volume compresses the spread down to a fraction of a pip and nearly eliminates slippage altogether. When your edge relies on capturing brief, rapid price movements, you cannot afford to pay wide spreads. You need to enter, grab your profit, and exit cleanly. High-frequency consistency requires the lowest possible transaction fees. For these traders, focusing exclusively on the majors is a strict mathematical necessity. Not everyone trades the intraday noise. Swing traders and fundamental analysts look for sustained trends based on diverging economic policies, and they often want to entirely avoid the overwhelming influence of the U.S. Federal Reserve. This requires minor, or cross-currency pairs. These pairs match two major economies against each other, completely bypassing the dollar. A classic example is the euro trading directly against the British pound. Removing the world's reserve currency from the equation changes the environment. Overall liquidity drops slightly, which means you will encounter wider baseline spreads compared to the majors. This split screen chart illustrates the trade-off. On the right, we see the strategic benefit. When you isolate two specific regional economies, the resulting price action often develops into smooth, persistent trends that last for weeks, cleanly reflecting shifts in local interest rates. Because swing traders hold positions over these extended periods, they are capturing massive point totals. That slightly wider entry spread is easily absorbed by the sheer size of the long-term move. Beyond the miners lies a tier of the market reserved for macro traders equipped to navigate extreme volatility and high structural costs. These are the exotic pairs. They lock a major reserve currency against the fiat of an emerging or developing market, like the US dollar against the South African rand or the Turkish lira. The mechanics here are harsh. Institutional volume is extremely low. Because the market is so thin, routine spreads can easily explode to 50 pips or more in the blink of an eye. Look at this standard stop-loss interface. A standard 20-pip boundary that keeps you safe in the euro-dollar will be violently shattered by normal background noise in an exotic pair within minutes. Developing economies can see more price movement in a single afternoon than a major pair experiences in an entire week. Capturing those moves requires deep geopolitical knowledge and enough capital to absorb the high transaction costs. This matrix maps out the solution. Your trading strategy dictates your environment. Scalpers and day traders belong in the hyper-liquid majors. Swing traders tracking policy trends belong in the minors. And only experienced macro analysts should step into the exotics. Once you identify your correct category, narrow your scope. Shallowly monitoring 20 different currencies guarantees you will miss the subtle rhythms of price action. Mastering the daily range and unique personality of just 2 to 4 specific pairs provides a measurable edge. Finally, align your execution with the clock. You must trade your selected pairs during their home market's active hours, like the London and New York session overlap, to guarantee the peak liquidity that keeps your costs down. Selecting a currency pair is an active defensive maneuver. This choice defines the physical terrain of your trade, setting the baseline costs and the risk parameters that determine your survival. Stop trading blind. Refine your pair selection strategy using FXNX's advanced charting tools and execute your edge with ultra-fast 0.0 pip spreads.